Another piece of news is the IRS came with some more information regarding the going away of the stretch IRA. What I'm talking about is if you're inheriting an IRA and you're not the spouse of the deceased, so that would be a non-spouse IRA, or you might hear me call it a non-spouse Benny IRA, Benny for beneficiary, meaning you're not the spouse of the person that died. So non-spouse beneficiary, the rules went away that you have to basically take the money out. You have 10 years to take the money out of it, where the old rule is you could do the stretch and take required minimum distributions over your lifetime to take distributions from that account. So it was small. It's basically a divisor, not percentage, but like if you're 70, that percentage is a little better than 3.5%. So if you were 50 and a Benny, it would be a smaller percentage of assets in that case, but increases as you age. But what they got to looking at over time is they took the protections from that, there's, if you went bankrupt or something, your IRA would be protected. Well, they took that away from the non-spouse IRAs, and then they went back and they looked at it again and they said, you know what? 70% of the people spend their IRA inheritance inside of 5 years. You know who keeps them intact? The big accounts. So let's put a stop to that. So let's have these spent down. And I know not all of you would do that, but 70% go through the money in a short period of time. And it could be because they want to pay off the house, pay off the credit cards, stuff. They could well be making really good decisions to pay off the kids' college debt and stuff like that. So I'm not saying you burn through the money, but they're looking at it from the standpoint it gets spent. So they said, well, heck, let's do away with that rule. Let's have the 10-year rule. And even if a kid's the Benny, once they reach age of majority, their clock starts on the 10-year rule. So the assumption was year 10 is 100% RMD, meaning year 10, you have to take it all out during that year. What's the requirement? 100% of the account. Well, now they come back and said, no, that's not quite it. The balance does have to be taken in year 10, but they said it's going to be required minimum distributions each year. So we don't know what that table or clarification is, but they're saying you're going to have to take a distribution each year. So for a taxable IRA, our thought was, if you're inheriting $500,000 in an IRA and you're not the spouse, you have to take money out. Well, you sure don't want to wait to year 10 and do it all at once and have a giant tax bill. Our thought it would be you take out $25,000. I'm sorry, you take out $50,000 a year each year, and it'd be a little bit more, but you get where I'm going. Let's spread it out so we're not jumping to the highest tax brackets in that case, and kind of do some planning. And maybe you need it for income, but you say, well, heck, I don't need that. Well, take some of it for income. You're going to have to pay taxes and maybe put that money elsewhere. And I'll give you an idea of where we could put that. But the other thing that it really impacts is Roth accounts that are left behind. Those are tax-free accounts that are left behind, because you can inherit an IRA, but you cannot convert it to a Roth. But if old James went to the doctor, and he has all this money, and the doctor tells him, James, I've got some bad news. Well, doctor, just spit it out. What is it? Well, you don't have long. What? How long do I have? Well, maybe 6 months. Cool. Are you sure about this? The doctor says, yeah, I'm pretty sure about this. This is the way it's going to go for you. I'm sorry. He said, that's cool. I got some things to do. I'll check in with you later. See if you change your mind. Where's James headed? He's headed to Gregory's firm to call them. Said, look, I want to convert my account to a Roth so I can leave it behind, tax-free money, because my kids can't convert it, but I can. I don't have long. I need to get this done. Well, how are you going to pay the taxes? I don't know, but I'm going to do it before I die. You get? So that's the power of the Roth. But they're saying, now they're telling your kids, James, you can't keep it forever. You're going to have to spend it in 10 years. And you're going to have to take distributions, because what should James's kids do? Wait till year 10 to take it out and let it double up, perhaps. So, okay. So that's kind of where they're kind of putting the kibosh on Roth IRAs, with that kind of rule adjusting or clarifying that. And there's going to be more information to come out of that. If you've got Benny IRA, you just prepare to take a distribution this year, and you should be kind of spreading it over 10 years. If it's Roth, wait till later in the year and get clarification on that distribution. My thought is, if you've got to take out money, and you're probably needing some of it, but we've got to spread that taxable money over 10 years. Here's the thought. I've got a max funding program, and we ran this, I think it's, with North American at 5+%. But our thoughts was, take some money for income and do things you need, pay taxes on that $50,000, and $25,000 of it, put it in a max funding strategy. Why? Let's create another income source. So do that for 10 years. Take that distribution, wind down that IRA, and at year 11 for this individual, and we'll just call this individual getting the non-spouse 60 years old. So at age 70, they could start income from that, and that's forecasted to be a little more than $24,000 a year in income. So if we just round it a little bit, you can almost call that $250,000 a year in income, and over 20 years from 70 to 90, you can do the math. 25,000 round. We're just rounding.
You accidentally said 250, but I think everyone knows you meant 25.
Well, it's 25,000 a year.
There you go.
10 years is 250,000.
Okay.
20 years would be 500,000. So it's 250 in, 500,000 out. No taxes on that income with that max funding strategy. If you want more ideas like that, James will give you a number to call.
Call Gregory Ricks & Associates, 504-832-9200. And you can always remember GregoryRicks.com. Thanks for hanging out with us tonight. Let's do it again tomorrow. I'm James Parker. We are Winning at Life with Gregory Ricks.